Hello, I'm Chris Sarley, Investment Research Analyst at Chelsea Financial Services, and today I'm delighted to be joined by Alistair Wittet, Manager of the Comgest Growth Europe's ex-UK fund. Thank you for joining us today, Alistair.
It's a pleasure. Glad to be here.
Many of the companies you invest in have pricing power and clean balance sheets. Can you tell us how that helps in an environment where inflation is perhaps proving to be more embedded in the economy than expected, and maybe the talk of interest rates rising soon as well, please?
Yeah, no, I think it's extremely important. I think for a lot of companies, they're seeing inflation come through not just in raw materials, they're also seeing it come through in labor costs, and it's a major challenge. And the companies that have strong pricing power are obviously very well placed to pass those price increases through. I can give you a few examples of companies that have done that. In the luxury space, Louis Vuitton has pushed through earlier this year between 4% and 7% price increases across a number of its different brands. But pricing power also applies outside of the consumer space. In the industrial gases space, for example, Linde has pushed through more than 5% price increases. And Assa Abloy, the leader in locks and entrance systems, has been pushing through 3% price increases. So pricing power is an extremely important tool for a number of these companies to offset the inflation that they're seeing. I think it's also true when we look at balance sheets. The talk in the markets, of course, today is about rising interest rates, and central banks across the world are setting out a plan for increasing interest rates in the years to come. And of course, this becomes very important when you consider the cost of debt for a number of companies. And those companies with low or no debt on their balance sheets should find themselves at a competitive advantage. And so if we look at the portfolio as a whole, in the case of the Comgest Growth Europe ex-UK portfolio, the leverage of that portfolio is around a third of that of the index. And we think that will set these companies in good stead.
I want to talk about one of your holdings first. ASML is the top holding in the portfolio. The firm's sort of one of the leading manufacturers of microchip equipment, and they recently gave us guidance through to 2030. Is it usual for a company to be able to see so far into its own future?
It's highly, highly unusual. Most companies are very comfortable giving you guidance for the year ahead. Some give guidance even for the quarter ahead. It's unusual to give guidance over 3 or 5 years, and extremely unusual to be giving it over 10 years. But ASML is in a very unique industry and operates a very unique business. They sell machines that are used to print chips in the semiconductor industry. And these machines are so complex that they take many, many years to develop. In fact, the machines they're selling today started their development in 2005, so over 15 years ago. And of course, therefore, the machines that they're working on today, they expect to be selling in 10 years or so. So that gives this company an unusual amount of visibility and means that they are able to, as you mentioned, to give 2030 guidance.
Another company you invest in is Novo Nordisk. Could you tell us about their obesity product? And I believe it's been agreed for use in the US now.
So this has been a huge piece of news. It's driven the share price of what is already a very large company, over 200 billion euros of market cap. It's driven that share price up significantly this year. Why has it been so significant? Well, the first point is that obesity is a huge potential market. More than 2/3 of the US adult population are either overweight or obese. It is a major, major problem in the US. Novo Nordisk is a diabetes company, and the technology behind their diabetes products, the biology behind it is very similar to that which could be used for anti-obesity. So they launched an anti-obesity product in 2015. That product did quite well, but they launched the latest generation of that product called Wegovy earlier this year. It is twice as effective as the first generation of products. And already within weeks of having been prescribed, Wegovy has seen more prescriptions than its predecessor did after 4 years. So there's a huge potential for this product. It's a market that could conceivably over $10 billion of revenue for the industry. And so we think this is a big opportunity for the company. And of course, that has also been reflected in the share price.
Thank you. I wanted to turn to China now. What has been the impact of the recent Chinese regulatory changes on the European companies you own?
Yeah, so there's been a lot of noise coming out of China, I would say, in the last few months. It all started, of course, with the aborted Ant IPO last year, and there is no question that the regulatory scrutiny has increased, but not just in the financial services industry, in the case of Ant, but we've seen it also in the education sector. They've They've clamped down on the private market for private education, and then more recently in gaming. So it's an important factor. The work that we have done and the conversations that we have had would suggest that the regulation is quite well thought through. Where regulation can be dangerous is if the regulator doesn't fully understand the industry and they put through blanket bans or blanket regulations that can create a lot of damage. In this case, it seems to be very well focused. And if I can give you just one example, in the gaming sector, for example, the regulation is limiting the number of hours per week that minors can play games to 3 hours a week. That seems to us a regulation that's quite sensible. For the industry as a whole, it's not very damaging. It's a relatively small part of their revenue stream anyway, and it seems like a piece of regulation that is targeting the dangerous part of gaming, which is of course for minors. So there has been more regulation, but I think it has, for the most part, been sensible, and it's not been hugely detrimental to the companies involved.
I was just going to ask, the latest update from the fund mentioned that there's been a sort of general boycott of Western companies by Chinese consumers. Could you maybe talk us through that and what's going on, how it can in fact impact the companies?
Yeah, so this relates to the Xinjiang region in China, where cotton is produced, and where there was a decision by a number of Western companies related to the Better Cotton Initiative to stop sourcing from there because of allegations of very poor labor practices. The Chinese government were obviously unhappy with this, and there was a general boycott of those Western brands who chose to stop sourcing from that region. Those are brands that include the likes of Nike or Adidas. So this has been unhelpful for these companies. For what it's worth, we think it's the right thing to do. I think it's to these companies' credits that they have stood up and acted on what seemed to be quite clearly human rights abuses. But in the short term, of course, it will hurt their revenue stream. Our expectation is that this will, in time, blow over because these remain highly desirable brands in the case of Nike, in the case of Adidas, and that we expect in time the Chinese consumer to return to these well-loved brands in China and, of course, overseas.
And just lastly, you show the fund's carbon and environmental footprint on the fund fact sheets. What exactly is that measuring, and why do you think that's so important?
Yeah, so this is the measure of the carbon emissions of the companies in what's known as scope 1, 2, and 3. So it's not just the carbon emissions of the company itself, but also of its supply chain. It also goes the other way and looks at the carbon emissions after the life of the product. So, for example, the recycling of clothing would be included in that emission. It measures the tons of carbon emitted per million euro of value of the business. So it's an important measure for us. It's not perfect, but we think it's a very good starting point for measuring the carbon emissions of the companies. In the case of the fund, it is around 80% below that of the index. And there's a number of reasons for that. The first is that the fund is largely exposed to clean industries. So it's largely exposed to the healthcare sector, to software companies. So it avoids by nature those very heavily polluting industries. But also within those sectors, within those industries, the companies are industry leading in their carbon emissions. And we think it's important for a number of reasons. But the most important one is that, of course, what we're interested in is growth financially for these companies, but we don't want that to come at the cost either socially or environmentally. And that's important not only for the investors in our companies, but of course it's very important for the long-term prospects of these companies, because what today seem like non-financial issues will become one day very real issues for these companies if they're not dealt with. So we think it is part of the long-term prospects of these companies it's important for the long-term prospects of these companies that they are taking into account these environmental considerations.
That's great, Alistair. Thank you very much for joining us today.
Thank you.
And for more information on the Comgest Growth Europe ex-UK fund, please visit chelseafs.co.uk.